Every morning, before you check your phone, before the stock market opens, before a single share of anything changes hands, a different market has already moved more money than most countries will see in a year. You've never heard of it. Neither have most investors. And that's exactly the problem. Think about the last time the stock market crashed. You probably remember it. Maybe you felt it. People talked about it on the news, at dinner tables, in panic group chats. Stock markets are visible. They have tickers. They have drama. They have a face. But underneath the stock market, underneath every market really, there's a plumbing system. Invisible. Unglamorous. And if it ever stops working, everything above it breaks too. That plumbing system is called the repo market. And it moves somewhere between $4 and $10 trillion every single day. Here's the simplest way to understand it. Imagine you own a very expensive watch. You need cash today, not tomorrow, today, but you don't want to sell the watch. So you walk into a pawn shop, hand over the watch, get cash, and agree to buy it back tomorrow at a slightly higher price. The difference between what you got and what you pay back is the interest. The pawn shop gets a safe, short-term return. You get liquidity. Everyone goes home happy. That is more or less what happens in the repo market. Except instead of watches, it's government bonds. And instead of pawn shops, it's banks, hedge funds, money market funds, and the Federal Reserve itself. And instead of tomorrow, we're often talking about overnight. As in, the money goes out at 4 p.m. and comes back by 9 a.m. This happens every single day, at a scale most people cannot picture. Now here's where it gets interesting. The repo market isn't some obscure corner of finance that only matters to specialists. It is the foundation of how the entire financial system stays liquid. When a bank needs cash to meet its obligations by end of day, it goes to the repo market. When a hedge fund wants to borrow money to amplify a trade, it goes to the repo market. When the Federal Reserve wants to inject or drain cash from the banking system to hit its interest rate targets, it goes to the repo market. This is the mechanism behind the mechanism. It's the room behind the room. And because it's all collateralized, meaning you always put up something valuable to borrow, most people assume it's safe. Boring even. The kind of thing that just works, quietly, in the background, forever. Then came September 2019. Out of nowhere, with no recession, no crisis, no obvious trigger, the repo market seized up. Overnight lending rates, which are normally calm and predictable, spiked to nearly 10% in a matter of hours. 10%. Overnight. For collateralized loans between major financial institutions. That's not supposed to happen. That's the financial equivalent of the pipes in your house suddenly running backwards. The Federal Reserve had to intervene immediately, injecting hundreds of billions of dollars into the market over several days just to get rates back to normal. And here's the part that should make you pause. Nobody has offered a fully satisfying explanation for why it happened. There were theories, a combination of corporate tax payments draining cash, banks hoarding reserves, regulatory changes tightening the flow. But the honest answer is that even the people running the system didn't see it coming. A market moving trillions of dollars a day almost broke. Quietly. On a Tuesday. And most people didn't notice until it was already over. The deeper you go, the stranger it gets. Because a lot of what moves through the repo market isn't traditional borrowing in any meaningful sense. It's the same collateral being pledged, repledged, and pledged again, sometimes 3 or 4 times over, in a chain of transactions that creates what economists call shadow money. It's liquidity that looks real, functions like real, but doesn't exist in any bank account you could point to. This is called rehypothecation, and it means that the actual amount of financial activity riding on any given pool of collateral is significantly larger than the collateral itself. The watch in the pawn shop has been promised to 5 different people simultaneously. As long as everyone keeps their word, the system works perfectly. The moment someone doesn't, you find out very quickly how many promises were built on the same foundation. None of this means the repo market is about to collapse. It probably isn't. It has worked, more or less, for decades. But it does mean that one of the most consequential financial systems on the planet operates at a speed, scale, and complexity that outpaces most people's understanding, including, occasionally, the people managing it. It means that when you hear someone talk about market stability, part of what they're actually hoping is that a market you've never heard of keeps humming along quietly in the background, as it does on most days. And it means that the next time something unexpected happens in the financial world, a sudden spike, a freeze, a liquidity crunch that appears from nowhere, there's a decent chance it started not in the headlines, but somewhere in the plumbing. The question worth sitting with isn't whether the repo market will break again. It's whether, when it does, anyone will understand it quickly enough to matter.